Hi guys, welcome to another video by Optionables. My name is Ayush and I'm a trader. In this video, we'll discuss about Nifty and Bank Nifty and how we can trade based on the levels for the next week, and in general how can you approach the market where every day every gamma move is coming, either it be initially with mid cap, then Fin Nifty, then again with Sensex last Friday, and this Thursday Nifty fell with a flash crash of 1% in a minute. So before we go on to the levels where we discuss how the market is positioned, there is something which I wanted to speak to you regarding what gamma moves are coming. So till now the index has not seen any flash crash. Everybody on Twitter or anybody on a social media platform is saying that we saw a flash crash. A flash crash would be anywhere above a 2 sigma event. For example, let's say Nifty in 2013 had fallen 6% in 5 minutes. So that was somewhere a 3 sigma or more than 2 sigma event, which generally doesn't happen in a decade or more than that. So now imagine on this Thursday when Nifty fell 300 points in 1 minute, the puts went from 7 rupees till a high of 210 rupees, which is like 30x. And many people who used to trade options based on stop loss, their stop loss jumped or their price never got traded, because ultimately the option which was trading at 7 rupee, it started to trade at 38 and then 100 and then directly at 200. So you have to be lucky if you are trading based on stop loss. So how can that be tackled? Firstly, you have to take care of your notional exposure. Like for example, let's say one lot of Nifty in cash can be done with 10 lakhs. So if you are doing it with a 5 lakh capital, you are having a leverage of 2 times. So in a case of 5% fall, you are not going to lose more than 10%. So that is much more feasible. But there are people who are like doing one lot with 30,000 using margin benefit hedge, and then they're doing. Imagine they would have got exit at the highest point in that fall and they were totally full on, like all in with the capital. They would have lost as high as 40% or 30% of the capital. So that is not some sort of trading, because ultimately you're going to make money of 99 times out of 100, and that one time you're going to blow up your account. So ultimately you are basically dependent on the luck that whenever such gamma blast happens or a flash crash happens, my stop loss will get filled. So that can't be done, because for every party or every order that you're shooting, the other party or the opposite party has to fill the quantity, and in a flash crash that won't happen. So now what can be the solution to this? The solution can be to this is trading with a leverage of not more than 1.5 to 2x notional exposure. Secondly, you can always prefer trading with a hedge based model, like for example where you, before taking a trade only, you know how much are you going to lose and how much are you going to recover, even if the market goes 10% down or 10% up. So that was the initial thought which I wanted to discuss with you guys. Now coming back to the video, Nifty has been looking weak since the gap down due to the Israel and Iran war. And one thing which is very clear to us is if you look into this range, for example, Nifty was trending in an upward channel and this channel got broken with this candle's low, and then ultimately the market went up. So now what can be the short term driven price action for the market is, until and unless yesterday's low, which was Friday, where the market opened gap down and Bank Nifty from 1% down till 1% positive closing happened. So that day's low can be seen as a immediate low or immediate support. Until and unless this level is not broken, the market can have a chances that it can bounce back, because ultimately for the market to change the trend, the market has to close below this level, which is like 21,600, or even if this level has to be followed, 21,700. And from the price action which has been there for last 2 months, it looks quite similar that the market can bounce back given the confidence region in this area. So for us, until and unless 21,750 or 21,700 is broken in Nifty, we are not looking to short the market aggressively. Or even if you are doing, you can trade strategies such as put ratios, or even like call side OTM ratios you can trade, because ultimately whenever the market is very volatile due to gaps or any event driven, you can't just simply sell puts or calls or equal strangle, because one gap of let's say 1.5% or 2% can literally destroy your trade. So one thing is, whenever you're trading overnight, you have to have your hedges closer, or you need to know your max loss. So that was our analysis for Nifty. Now we'll go to Bank Nifty and we'll analyze. So for Bank Nifty also, if you see clearly, the market after this Iran war from for all-time high level where it was giving consolidation in the last video, I was having the thought that the market might consolidate here, but ultimately will go up. That went completely wrong. And due to this Iran war, firstly we had a gap down of 1.6% that day, and next day also we saw 0.6% gap down. Then followed by that we fell 1% more. So ultimately, due to the Iran and Israel war, rather that be the reason or whatever be the reason of profit booking, the market has more or less fallen 3% in 3 days. But what we saw on Friday was something crucial, because ultimately, initially the market went 1% down. From there, the market recovered 2% to close 1% positive, which is a very bullish sign, because whenever you see that the market is opening gap down and going down, but ultimately some buyer is coming and throwing away all the sellers, shows that some big party has entered the trade and they are not going to lose it over just 1 day or 2 days. So until and unless this low in Bank Nifty is also broken, which is the level of 46,500, Bank Nifty looks good for a reversal. And higher levels, if we have to watch, the previous all-time high level, which was 48,450. Within this range, the market can trend for the next week, but the volatility is going to be on the higher end. You can see that ultimately on the same day, the market can test even 1% up, and again on the same day, it can close 1% down. So on such days, it is better to not have naked exposure over options and always have a risk defined trade. So that will help you, even let's say market falls 2%, so your risk is defined and you're not going to lose a lot of money over a bad day. So that was our analysis for this week. If you like this video, like, share and subscribe to the channel. Thank you.